So now we understand what it takes to come up with the right price to offer on the right home. Let's go over a couple extra details on how buyers can craft the perfect offer. This is really important because, of course, it's going to help the buyer remain in control of the transaction, as well as establish very necessary contingencies to get out of the contract if stuff comes up throughout the process. So let's jump in by starting with the option period. Typically, when you go under contract for a home, you're going to establish a period of time of which you as a buyer has to go out and inspect the home and make sure that everything is correct or okay with the home before being committed or locked into the transaction. For most markets, a typical option period or inspection period is going to be 7 to 10 days. And typically, the seller is going to ask for a small fee or deposit to be put down so that way you can start your option period. In most markets, this is going to range from $300 to $500, and usually it's not going to eclipse 1% of the total purchase price of the home. This is when, again, you're going to have the inspector come out and do a thorough inspection. If there's foundation issues or roofing issues, you may have a different inspector come out and make sure, again, that these different parts of the home are solid and sound. Next, let's talk about the earnest money deposit. This is something that you establish in your contract as well. And this is the amount of money that you're willing to put into escrow that will be at risk throughout the transaction. But of course, as your contingencies are established, you may be able to get this money back. In most markets, this is going to be 1% of the purchase price. Of course, if you establish contingencies like I mentioned, which we're going to go into further detail here, the contingencies will allow you to have an allowable out, meaning you're able to get this money back. But as a buyer, what you always want to be prepared for is that 1% is going into escrow. You want to make sure your contingencies are sound and you have different outs established. Next up, we have our closing timeline. So this is something that a buyer can manipulate to really improve their offer and make it more appealing to a seller, especially if a seller has to, move out of the home or they're trying to close on a new home themselves. You can tighten up that timeline and really try to make your offer more aggressive. So this is more relevant in a seller's market where there's a lot of offers and there's a lot of activity in that market. So for example, in Texas in 2020, 2021, when the market was crazy, we started to close the majority of our clients at my mortgage company within 10 to 15 days. And so what this really allowed to do, our buyers to do was compete against cash. And when you can compete against cash, your offer looks a lot more appealing to a seller, right? They get their funds a lot quicker, it's out of their hair, and they can move on with whatever they need to do on their side. Next, we have title insurance. So title insurance is one of the largest costs that's itemized to either the buyer or seller throughout the transaction. And in most markets, whoever gets to choose the title company is usually left footing the bill when it comes to the title insurance. So for example, in Florida, right, the buyer typically is going to choose the title agency, and they're also going to foot the bill for the title policy, which a lot of these times is going to cost anywhere from $2,000 up to $6,000-$7,000 depending on what purchase price you're shopping at. In Texas, it's completely opposite, where usually the seller will choose the title company and they will pay for the cost of the title insurance policy on behalf of the buyer. This is a really big swing one way or another, so just be very careful as you start to speak with your realtor about coming up with the right strategy. Just realize that if you elect to pay for this cost, you are significantly increasing your closing costs, right? In a state like Texas or California, where it's very affordable and inexpensive to buy property, you could be doubling the amount of your closing costs simply by picking up the title policy. So be thoughtful about it. Again, be aware of what type of market you're in, but this is a way that you can make your offer look more appealing. So for example, if there's 10 offers on a home, right, instead of going up on a purchase price $5,000, $10,000, $15,000, you could just come in and ask and then say, hey, I'm willing to pay the title policy, which saves the seller on their side of the closing costs. Next up, we're going to talk about the contingencies, at least the most important ones. So let's start by simply defining what a contingency is. A contingency is a clause in the contract that allows a specified party, such as the buyer or the seller, to opt out or terminate the contract without facing any type of legal or financial ramifications. If not met, the buyer or the seller get a full refund of any earnest money deposit. So, contingencies should be looked at, if you're the buyer, as your best friend. These are additional safety nets put in place to protect your earnest money deposit as you go through the transaction to make sure that the home is the right fit for you. I've listed out the most common types of contingencies on the screen for you. We're going to jump in and go through, again, the most common contingencies exist and why it's important to understand them and make sure that you have proper protection throughout the real estate transaction. Let's start by talking about our appraisal contingency. This is arguably the most important contingency in a real estate transaction. That's because it protects the buyer in the event that the appraisal comes in lower than the agreed upon purchase price. It also protects the consumer, the buyer, if for whatever reason the appraisal doesn't meet the specified requirements of the lender's underwriting department. So, not appraising at the minimum specified amount is the most common reason these contingencies are triggered. That's because value is very subjective, right? One appraiser may have a different value than the other. However, appraisals are determined by comparables or comps in the market and, of course, the agreed upon purchase price. A complete waiver of your appraisal contingency is really dangerous. And the reason that is because, for example, if the loan amount comes in, if the appraisal comes in lower than the agreed upon purchase price, the buyer is now responsible to cover the gap with cash because lenders will only lend to the lower of the two between the purchase price and the appraised value. So I'll tell you just from my experiences in 2020 and 2021, when the real estate market was on fire, we had a lot of students and a lot of buyers out there waiving their appraisal contingency without really understanding the ramification. And so if something happens and the appraisal comes in low and you cannot close that gap with cash, what ends up happening is that you forfeit your earnest money deposit, which can be really tragic and a loss of anywhere from $5,000, $10,000, $20,000 because at the time it was very common for people to put a lot of money into escrow to kind of strengthen their offer. And then, of course, there's the other clause, which is the underwriting requirements, right? So sometimes the contingency will be triggered if, for example, the foundation is really shot, right? At that point, the lender can't lend to the buyer because the foundation isn't sound. So you can use the same contingency to terminate and get your earnest money deposit. Let's look at an example together where we go through what happens if an appraisal comes in low or doesn't make our value. Assume that we're purchasing a $700,000 home. We will give ourselves the ability to terminate if the appraised value doesn't come in at least $695,000. If the appraisal comes in at $693,000, the contract can be terminated, right? Because it's below our threshold of $695,000 that we've established in our contingency. If the appraisal comes in at $697,000, for example, I don't have the ability to terminate because I, of course, agreed that I would draw the line in the sand at $695,000. But if the appraisal comes back lower than your minimum specified amount, don't just terminate if you absolutely love the house or this is your dream house. Use the appraisal as additional leverage to try to renegotiate. In the next class, I'll show you how we can renegotiate a low appraisal in the event that happens. Next up is our financing contingency. The financing contingency establishes a specified period of time that the buyer has to obtain a full loan approval from their lender. It's really important to understand that a full loan approval consists of two different pieces. The first one is the credit approval or the buyer approval. And so, for example, if you lose your job in the middle of the process and you have a financing contingency established, this means that you can terminate the contract and get your earnest money back. Another good example, which I've seen a few times, is if, for example, the buyer doesn't disclose to the lender that they're divorced and it comes up throughout the process. Again, if it's within the financing contingency period, the buyer can terminate and get their earnest money back. The property approval allows the buyer to terminate the agreement if, for whatever reason, the property itself doesn't qualify or meet the necessary lender requirements. So there are two reasons we see this triggered most commonly. That's going to be because of the appraisal, and a lot of the times if there's an HOA, issues with the HOA itself. So going back to the appraisal, if there are issues, for example, with the big three, which are the roof, the foundation, or the termites, the property sometimes will be disqualified for financing altogether. Next up is the HOA or the condo association. Sometimes, if they don't have the necessary reserves or their finances aren't in order, the entire complex itself will be disqualified for financing. In the event that this happens, and for whatever reason the property is disqualified from financing, as long as the contingency is in place, the buyer is able to get a full refund of their earnest money deposit and able to terminate the agreement without ramifications. If you want to waive your financing contingency, make sure it's something that you think long and hard about. We saw this very often in 2020, 2021, and 2022 when the market was a seller's market and buyers were in a frenzy trying to do whatever they could to improve their offer and go under contract for their dream home. If and when something goes wrong during the lending process, for example, you lose your job or you take on too much debt, anything at all, if something comes up and your lender has to deny you, you will not be able to get your earnest money back if you waived your financing contingency. So, there is a way to mitigate the majority of this risk is when you're working with a lender, ask them to do a full underwritten pre-approval up front. This will guarantee, or at least almost guarantee, that nothing else can come up, at least with the credit approval, during your buying process. Of course, there's always a risk that something can happen with the property approval or the collateral approval, which we just touched on, but at least the majority of the risk is taken off the table and you're no longer worried about something popping up and you losing your earnest money deposit. Next up is your inspection contingency. This is typically built into the contract through your option period. Now, this is important because it allows the buyer to terminate the contract with little to no explanation to the seller. So whether there's minor or major defaults with the property, or you just no longer like the property, as long as you have a inspection contingency, you can terminate the contract, get your earnest money back, and get back to shopping for a new home. This is the number one contingency that we do not recommend waiving under almost any circumstance. It just doesn't benefit the buyer to not be able to do a thorough inspection on the property before making such a large investment. $500 to $1,000 is the typical cost of an inspection, and it's money well spent so you know exactly what you're investing in and what you're buying. I'll give you a horror story from one of my clients from 2021 when, again, it was a seller's market and buyers were in a frenzy. So my buyer decided to, because they were buying a new custom home, they decided to waive their inspection contingency. And what ended up happening is 2 weeks before closing, there was a major foundation issue. This would have been caught up front, but because it wasn't, because they decided to waive their inspection contingency, they ended up getting 2 weeks away from closing before they discovered a major foundation issue with the home. So what they ended up doing was they ended up terminating the contract and losing $25,000 of earnest money to the builder. So just be diligent and make sure you're doing what it takes to have a proper inspection done on every type of property you're going to buy, whether it's a condo or it's a townhome or it's a single family home. Always get that inspection done and make sure you know exactly what you're investing in. This will help eliminate any type of buyer's remorse or major issues popping up down the road. Next is a pending sale contingency. This is when the buyer has to sell a separate piece of property, usually their primary residence, to come up with the necessary funds to close on the new home. As you can start to see, real estate transactions can be a little bit tricky. So think of it from the seller's perspective. If there's a whole separate real estate transaction outside of their control that they have to now worry about, it adds an entire new level of risk to the seller. So most of the time as a buyer, you want to do what it takes to make sure that your offer doesn't include a pending sale contingency. During 2020 and 2021, when the market was crazy, you saw a bunch of startups come into the market that helped address this issue in particular. The reason was because, as a buyer, it was nearly impossible to get an offer accepted with a contingent sale. So a bunch of these startups came in and they offered cash up front to the buyer for a fee, and then they controlled the listing process of the home after the closing of the new home. So if you're in this situation, you may want to look for alternative options depending on what type of market you're in. Let's talk about less used or less critical contingencies. These will typically be more property or location specific. We already talked about it a couple minutes ago, but we'll touch on HOA or condo contingencies separately because sometimes in the contract they are separated out as their own contingency. This is going to be very relevant if you're shopping in a downtown urban area or you're looking just for condos. So this is extremely important in the Florida condo market because again, the HOA and the condo association have to be fully qualified by the lender. And so it is a rigorous progress that the lender puts them through. They look at their financials, their insurance, their master policies, their history of settlements and claims, and they're all reasons that the lender could potentially deny the complex or the property itself. HOI contingency, or what's called our homeowners insurance contingency, has become much more prevalent over the last couple of years in particular states like California and Florida, where homeowners insurance has become very unaffordable very quickly. So think about Florida, right? We have a lot of flood risk, we have hurricane risk, and in California, we have wildfire and earthquake risk. So what's happened is homeowners insurance premiums and costs have gone through the roof. So nowadays, buyers want to have an out or protection if they can't obtain the proper coverage or simply if coverage is way too expensive. If you don't know whether or not you need these contingencies in your contract, my advice is simple. Lean on the advice of the professionals that you've elected to work with in your lender and your realtor. I will tell you from my experience dealing with thousands of students and clients over the years, it seems to me that these contingencies in specific states are becoming more and more relevant. So if you catch yourself buying a condo or you happen to live in Florida and New York, make sure you're being thorough and you ask your lender and your realtor what do they think about putting these contingencies in place.